Welcome back to the channel. Sony just shattered its own records with a quarter that's rewriting the rules of entertainment and technology. Think profit surges, anime blockbusters, and a jaw-dropping share buyback that screams undervalued. If you want the inside story on how Demon Slayer is transforming global pop culture, why Sony's cutting-edge sensor business dominates the smartphone wars, and what's really happening behind PlayStation's billion-dollar headlines, yes, even those Bungie curveballs, this is the one breakdown you can't afford to miss. Stick around till the end for exclusive insights on Sony's next big moves and how they could impact your investments. It's not just a recap, it's your edge in the market.
All right, let's jump straight into the top line result, because this quarter, Q2 FY2025, was genuinely historic for their continuing operations.
Yeah, absolutely historic. We're talking new record highs for both sales and operating income. It was quite the performance.
Okay, break down those numbers for us.
Sure. So consolidated sales hit 3,107.9 billion yen. That's up 5% compared to the same quarter last year, year on year.
5% growth?
Yeah.
Solid. But profit, that's where it gets really interesting. Operating income, or OI, surged 10% year on year, hit 429.0 billion yen.
Wow, 10%.
Yeah, and that translates to a pretty hefty operating margin of 13.8%. Even net income was up 7%, reaching 311.4 billion yen, which, beat what analysts were generally expecting.
Okay, so setting records like that, usually that means management's feeling pretty good about things going forward, right?
That's exactly the signal. And they backed it up. They significantly raised their full-year guidance for continuing operations.
How significant are we talking?
Well, this wasn't just a little nudge. They boosted the full-year operating income forecast by 8%. That's an extra 100 billion yen they expect to make, bringing the target up to 1.43 trillion yen.
100 billion yen increase.
And then the sales forecast got a bump, too, up 3%, or 300 billion yen. So they're now aiming for 12 trillion yen overall.
Yeah.
That 1.43 trillion OI target. That's them saying, look, this strength isn't just a one-off.
Right, they see momentum. So if they're raising guidance like that, we need to understand where that strength is really coming from. Let's dig into the segments. Which one was the real star performer? The profit engine, so to speak.
Oh, hands down, that was Imaging and Sensing Solutions, INSS. It was, just firing on all cylinders.
Okay.
Record quarterly highs. Sales climbed 15% year on year to 614.6 billion yen. But the operating income, this is the number, it surged an incredible 50% year on year.
50%.
50%, reaching 138.3 billion yen. I mean, when you see margins expand like that, you know something fundamental shifted.
Yeah, a 50% jump isn't just volume. Is it the tech itself? What's driving that?
It is absolutely the technology.
Yeah.
It's fueled by image sensors for mobile phones, but the key here is a strategic shift. They're making and selling larger sensors now.
Larger sensors, like physically bigger.
Exactly. Think more sophisticated, higher performance sensors. They're going into new high-end phones from a major customer. And because they're more advanced.
They can charge more.
Precisely. Higher unit prices. Plus, they actually ship more units than they'd initially planned for.
Yeah.
So better tech, higher prices, and more volume than expected.
That's a powerful combination.
It really is.
Yeah.
And what's fascinating, internally, this INSS segment is looking so strong that management is apparently already thinking about whether they might need to raise the forecast again just for this segment in Q3.
Wow, okay, so that's the tech engine really humming. What about the content side? Music, did it keep up? Because that also hit record highs, didn't it?
It absolutely did. Music had a fantastic quarter. Sales jumped 21% year on year to 542.4 billion yen, and operating income was up 28%, hitting 115.4 billion yen.
Strong growth there, too. Is that mostly just, streaming, carrying the load?
Streaming was definitely a big part of the base.
Yeah.
Solid momentum. Recorded music grew 12% year on year. Music publishing was up 25%, both in U.S. dollar terms. But the real kicker, the thing that pushed them into record territory, that was the visual media and platform business. Specifically, they called out the massive global success of the anime film Demon Slayer. Kimetsu no Yaiba Infinity Castle.
Ah, Demon Slayer. That thing is everywhere. So that's the synergy, right? Own the IP, make the movie, reap the rewards across different parts of the business.
Exactly. It's the perfect example of their integrated model working.
Yeah.
A huge cultural hit like Demon Slayer just flows through music, film, and even their streaming platform, Crunchyroll. It validates that whole structure.
Okay, makes sense. Now, let's tackle the elephant in the room, or maybe the black hole as we called it. Game and network services, PlayStation. Because the reported profit number looked bad.
Yeah, GNS always needs a careful look. The headline numbers are confusing. Segment sales actually went up 4% year-on-year to 11,113.2 billion yen, which is good.
Okay.
And PS5 console sales were decent, 3.9 million units, just slightly up from last year. Monthly active users also grew a bit, up 3% to 119 million, so the platform itself seems okay. But the operating income fell 13% year-on-year, down to 120.4 billion yen.
Right. That's the jarring part. Sales up, users up, but profit down significantly. Was it poor game sales, or is this accounting stuff?
It was almost entirely accounting noise. That's why we called it the black hole. There were about 49.8 billion yen in non-recurring losses that just completely obscured the underlying health of the platform.
Okay, nearly 50 billion yen. We need to break that down, especially with all the talk about their studio acquisitions.
Right. So the biggest piece of that, 31.5 billion yen, was an impairment loss related to Bungie.
Bungie, the Destiny studio they bought. Impairment means?
It means they had to write down the value of Bungie's assets on their books. Basically, they admitted that the future income and player numbers from Destiny 2 and maybe other Bungie projects just weren't going to meet the, frankly, very high expectations they set when they made the acquisition.
Ouch. So they overpaid or overestimated Destiny's future, essentially. What was the rest of the charge?
The other 18.3 billion yen was an expense for correcting capitalized development costs.
Okay, what does that mean in plain English?
It means they had previously treated some game development spending as an asset on their balance sheet, believing those games would generate future profits. Now, they've had to revise that outlook for some projects and basically say, okay, we are too optimistic. These costs need to be expensed now, hitting the current profit.
That sounds like some missteps in managing their game pipeline, especially in that tough live service market. But you said these were non-recurring one-off charges.
Mostly, yes. Impairments and corrections like these are generally considered non-recurring, though the Bungie situation obviously raises questions about that specific investment.
So the crucial question for you listening, if we mentally pull out that 49.8 billion yen noise, what did PlayStation's real profitability look like?
This is key. If you exclude those charges, GNS operating income would actually have increased by 23% compared to last year.
23% up.
Yes. Driven by the stuff that matters long-term. Network services revenue, like PlayStation Plus subscriptions, and digital game sales. The core platform is healthy. It was just hit by these big one-time adjustments related to studios and development accounting.
That context changes the picture dramatically. Okay, let's quickly touch on the other segments. Pictures.
Pictures was a bit down. Sales dipped 3% year-on-year, and OI fell 25%. The main reason was just timing. They didn't have the same kind of big theatrical hits in this specific quarter compared to last year's Q2.
But Crunchyroll helped.
Yeah, strong revenues from Crunchyroll, their anime streaming service, did provide a cushion. It shows the digital streaming side is becoming more stable for them.
And the last one, entertainment, technology, and services, ET&S, the consumer electronics bit. Still struggling.
Yeah, ET&S continues to be a tough spot. Sales were down 7% year-on-year, OI down 13%. Management pointed to lower TV sales displays, as they call them, in what they described as a severe operating environment.
So tough market for TVs.
Tough market. And it's still getting hit by those U.S. tariffs as well, which doesn't help margins on those products. It remains a drag.
Interesting contrast, right? World-leading sensors, but struggling to sell TVs. Let's connect that struggle to the big strategic shift they announced spinning off the financial services business.
Right. This is a really big deal long-term. The partial spinoff of Sony Financial Group, SFGI, took effect October 1st, 2025. So going forward, financial services is treated as a discontinued operation.
Meaning Sony becomes...
It simplifies the company enormously. The focus is now purely on the core. Technology, like those sensors, and entertainment, like games, music, movies.
Okay, but that spin-off announcement came with this enormous, kind of scary-sounding accounting loss figure attached to it. Something like 1.38 trillion yen. Should people worry about that number?
Yeah, it looks terrifying on paper, but management was very clear. This is accounting noise, not a real cash loss. It's related to something called AOCI reclassification. Accumulated other comprehensive income. Think of it like a holding area on the balance sheet for certain gains or losses that haven't been fully realized yet. When they spin off SFGI, accounting rules require them to move these accumulated amounts around.
So it's not cash going out the door. It doesn't affect the profitability of the ongoing tech and entertainment businesses?
Exactly. It's just moving figures between different equity accounts on the balance sheet. It has zero impact on total equity, zero impact on cash flows, and zero impact on the profit or loss of the continuing operations we've been talking about. The strategy is simplification. The giant number is just accounting procedure.
Got it. And underlining their confidence in this leaner, focused future, they also announced a big share buyback, didn't they?
They did. A new share repurchase program starting November 11th, 2025. They authorized buying back up to 35 million shares, or up to a maximum value of 100 billion yen.
Which signals?
It's a huge vote of confidence. When management raises guidance and announces a substantial buyback at the same time, they're essentially shouting to the market, we think our stock is cheap right now relative to where we see the business going.
Okay, so let's pull all this together. Looking ahead, what are the biggest opportunities, the bullish catalysts for Sony now?
I see two main pillars, really. First, just the sheer momentum in that core high-margin technology, INSS. Those larger, pricier mobile sensors driving that 50% OI surge. That's the engine.
The profit engine.
Exactly. And second, the shift they're making in gaming, moving beyond just relying on the PS5 console.
Like Helldivers 2.
Helldivers 2 is the perfect example. Massive hit on PC as well as PlayStation. It proves they can take their IP cross-platform, reach a wider audience, and generate higher margin revenue streams that aren't tied only to console hardware sales.
Makes sense. And the simplification from spinning off financial services, how does that play into the opportunity?
That's potentially a major valuation catalyst over time. Getting rid of a complex, lower growth, lower multiple financial business should, in theory, allow the market to value the remaining high-growth tech and entertainment assets more appropriately. Give them a higher multiple.
Okay, sounds promising. But we need balance. What are the persistent risks, the headwinds they're still facing?
Well, number one has to be execution risk in gaming, GNS. That nearly 50 billion yen in charges, especially the Bungie impairment, shows just how hard it is to succeed consistently in that AAA live service space, integrating studios, launching hits. It's tough and expensive when it goes wrong.
Right, the Bungie write-down is a clear warning sign there. And the other drag.
It's still ETNS, the consumer electronics side. That severe operating environment for TVs isn't likely to vanish overnight. It needs ongoing restructuring, serious cost control, so it doesn't keep pulling down the overall results. It's the next big area needing attention now that finance is being spun off.
And the external factors, tariffs, currency, are those still biting?
Oh yeah. They're forecasting a net drag of about 50 billion yen on operating income for the full fiscal year just from U.S. tariffs. GNS gets hit with 30 billion of that, ETNS with 20 billion.
Still significant.
And currency is always a wild card. They estimate that just a 1 yen strengthening against the U.S. dollar could knock about 4.0 billion yen off the annual OI for their tech and gaming segments combined. So currency swings matter.
Okay, so summing it all up, record results, raised guidance, a huge buyback signaling confidence, but also some clear challenges. What's the key takeaway for someone trying to understand the investment picture here?
I think the absolute key is separating the temporary noise from the underlying structural trends. That GNS profit decline, that was mostly transient noise, the impairment, the accounting fix.
Right.
The underlying trend network services software sales, that 23% adjusted OI growth that looks structurally strong.
So value gaming based on that underlying strength, not the messy headline number.
Exactly. And then there's INSS. That segment, with its incredible margins and growth driven by advanced tech, arguably deserves a premium valuation, like you'd give a top semiconductor company. Is the market fully pricing that in yet within the larger Sony structure? Maybe not.
And the spinoff helps unlock that value.
That's the goal. Focus the company, make it easier for investors to see and value the high-growth parts, like INSS and the core gaming network. History suggests markets often reward that kind of simplification with a higher valuation multiple over time.
So the big question really is, will the market finally reward the high-margin, high-growth tech and content segments now that the conglomerate structure is simplified? That seems to be the core bet here.
I think that captures it perfectly.
We are not certified financial advisors, and this content is only for educational purposes. If you are considering making any investment decisions, please consult a certified financial advisor.